What is the SEC? The Securities and Exchange Commission, SEC, is a U.S. federal agency responsible for regulating the securities markets. Its mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation for companies. Key focus areas. The SEC primarily focuses on the following areas: preventing fraud and misleading disclosures, regulating stocks, bonds, investment advisors, broker-dealers, and mutual funds, ensuring that public companies provide accurate financial reporting, taking enforcement action against individuals or companies that violate securities laws. Why is this relevant to real estate? The SEC typically becomes involved when a real estate transaction is structured as an investment product rather than a standard property purchase or sale. This often involves real estate partnerships, funds, debt financing, or fractional ownership arrangements where investors expect to derive profits from the efforts of others. A simple example: if someone raises capital for a real estate project, promising returns, but fails to clearly disclose the associated risks, fees, or intended use of the funds, the SEC may deem this a securities matter. This is also why many real estate fraud cases ultimately evolve into SEC enforcement actions. What is a PPM? A private placement memorandum, PPM, is a legal disclosure document used by companies or funds when raising capital through private investment. It outlines the details of the transaction, associated risks, terms, and other material facts to help investors make informed decisions. Its purpose: to articulate key investment information, including how the financing works, exactly what investors are purchasing, potential returns, and any applicable restrictions. To clearly explain the risks involved, particularly because private placements are typically not registered with public regulatory bodies in the same way that publicly listed securities are. To help protect the issuer by demonstrating that investors received full and adequate information prior to making their investment. Applicable scenarios: PPMs are commonly encountered in private real estate transactions, hedge funds, private equity, and startup financing. In practice, it is often one of the most critical documents an investor reviews before deciding whether or not to invest. A simple example: if a real estate sponsor wishes to raise capital from a select group of investors to acquire an apartment building, the PPM would detail the specific property, the business plan, anticipated risks, fees, and the rights of the investors. What is the relationship between the SEC and a PPM? The relationship is simple. A PPM is a disclosure document used in many private securities offerings, while the SEC is the regulatory body that establishes and enforces the rules governing these offerings. Even if certain offerings are exempt from full SEC registration, a PPM is frequently used to provide investors with sufficient information and to mitigate the risk of violating securities anti-fraud rules. How they relate: the SEC typically does not pre-approve PPMs. Instead, through the PPM, the issuer demonstrates that it has adequately disclosed the details of the transaction, associated risks, fees, and the intended use of funds. If a PPM is misleading, incomplete, or omits material facts, the SEC may initiate enforcement actions. Its role in real estate. PPMs are particularly important in real estate investment partnerships, funds, or fractional ownership investments, as investors are typically passive participants who rely primarily on the sponsor for management. The SEC focuses on the following: whether the offering structure complies with regulations, whether investors have received truthful disclosures, and whether the sellers have adhered to exemption rules such as Regulation D. A simple summary: SEC =, the rule maker and enforcer. PPM =, the disclosure document used in private offerings to ensure compliance with the rules. A well-crafted PPM does not guarantee absolute immunity, but it serves as evidence that the issuer has truthfully disclosed the transaction and provided investors with the information necessary to make an informed decision. What is Regulation D? A comparison of Rule 506B and Rule 506C and the differences between them. Under Regulation D of the Securities Act of 1933, both Rule 506B and Rule 506C allow companies to raise capital without the need for full registration with the SEC. However, they differ in their approaches to marketing and their requirements regarding investors. Rule 506B prohibits general solicitation or advertising. It permits fundraising from an unlimited number of accredited investors, as well as up to 35 non-accredited investors who possess sufficient financial sophistication. Furthermore, it typically allows investors to verify their status as accredited investors through self-certification. Rule 506C permits general solicitation and advertising, but participation is restricted exclusively to accredited investors. Additionally, it requires issuers to take reasonable steps to verify the accredited status of their investors. Overall, Rule 506. B relies more heavily on pre-existing relationships and entails relatively relaxed compliance requirements, whereas Rule 506C is better suited for broader market promotion but imposes stricter requirements for verifying investor eligibility. What is the difference between an accredited investor and a non-accredited investor? An accredited investor is an individual who meets specific financial or professional thresholds established by the U.S. Securities and Exchange Commission for SEC, for instance, by possessing a high income, a high net worth, or relevant professional licenses. A non-accredited investor, conversely, does not meet these thresholds and typically has access to fewer private investment opportunities. Asterisk, asterisk. Key differences, asterisk, asterisk. Accredited investors are eligible to participate in a wider range of private and high-risk investment vehicles, such as private placements, venture capital funds, and certain hedge funds. Non-accredited investors are generally limited to participating in more strictly regulated public market investments, such as stocks, bonds, mutual funds, and exchange-traded funds, ETFs. The rationale behind these regulations is to reflect the differences among investors regarding their level of financial sophistication and their capacity to bear risk. Asterisk, asterisk, common SEC thresholds. Asterisk, asterisk. An individual investor is typically deemed an accredited investor if they meet one asterisk of the following criteria: an annual income exceeding $200,000 for each of the 2 most recent years, or if filing jointly with a spouse, a combined household income exceeding $300,000, a net worth exceeding $1 million, excluding the value of their primary residence. Asterisk, asterisk. Simple example, asterisk, asterisk. Suppose 2 individuals are interested in investing in a startup company. The accredited investor might be able to subscribe directly to shares in the company, whereas the non-accredited investor, due to not meeting the eligibility requirements, would likely be unable to participate in that private investment. What is REIT? A REIT stands for Real Estate Investment Trust. It's a type of company that owns, operates, or finances income-producing real estate. Instead of buying property yourself, you can invest in a REIT and earn a share of the income, like rent or mortgage interest. In simple terms, a REIT is like a mutual fund for real estate. How REITs work: they pool money from many investors, use that money to buy or finance properties, earn income, rent, leases, or interest. Pay most of that income back to investors as dividends. Types of REITs: equity REITs own physical properties, for example, apartments, malls, office buildings. Mortgage REITs lend money for real estate. Hybrid REITs do both. Key features: traded on stock exchanges like shares. High dividends. They must distribute 90% of taxable income in many countries. Provide exposure to real estate without owning property directly, easy to buy sell compared to physical real estate example. If you invest in a REIT that owns shopping malls, the REIT collects rent from stores. You receive a portion of that income as dividends. What is crowdfunding in SEC.gov? Crowdfunding on U.S. Securities and Exchange Commission's website, SEC.gov, refers to a regulated way for companies, especially startups and small businesses, to raise money from the public online. What it means: crowdfunding, under SEC rules, allows a company to offer and sell securities like shares, debt, or convertible notes to a large number of investors through the internet. This is governed by Regulation Crowdfunding, Reg CF. Key features of SEC Crowdfunding 1, online platforms only. All offerings must go through an SEC-registered intermediary, such as a broker-dealer or a funding portal. 2, fundraising limit. A company can raise up to $5 million in a 12-month period under Reg CF 3. Who can invest? Both accredited and non-accredited investors can participate, but investment amounts are limited based on income and net worth. 4. Required disclosures. Companies must file details with the SEC, including business description, financial statements. Use of funds risks. This is typically filed as Form C on SEC.gov R5. Investor protection. There are rules to prevent fraud, Ensure transparency, limit how much individuals can lose. Simple example. A startup wants $1 million to expand. Instead of going only to venture capitalists, it lists its offering on a registered crowdfunding platform, allows hundreds or thousands of people to invest small amounts. Files require disclosures with the SEC. Why it matters: crowdfunding through sec.gov opens investment opportunities to the general public, helps small businesses access capital more easily, creates a regulated and transparent environment. Thank you for watching.
When you arrive in a network